The smart money is clearly starting to move in. That to me is the indication, one big indication of the start of a big move.
Imagine a future not so far away where the shimmer of silver isn't just for show, but a beacon of booming wealth. You're not in a sci-fi movie. You're watching a very real possibility unfold as the silver market prepares for a seismic shift. Today, we're not just discussing any ordinary price increase. We're delving into why experts like Peter Krauth are sounding the alarm on a rally that could make history. With a global deficit escalating and demand soaring to heights unseen, the stage is set for silver prices to shatter records. If you've ever wondered what could catapult silver into a league of its own, far surpassing its past, you're in the right place. Keep watching, because we're about to unravel the combination of extraordinary factors that could propel silver to its highest valuation ever. Get ready to uncover the reasons behind the rallying cry for silver. This is not just another market trend. This is the genesis of a rally like no other.
I've been saying, and I'm surprised, I've been saying silver is going to reach $28 in the in the second quarter this year. Here we are, we're 10 days in, and it's already at $28. Honestly, at this point, it's been quite the run up, both metals. A bit of a pullback would not surprise me at this point to digest some of those gains. I'm not saying it's going to be extended or deep, but I could see, perhaps some kind of a quieting or a sideways move, small pullback over the next, say, week or couple of weeks. And I think that we're going to at least maintain and perhaps push higher. I think that the second half of this year could see us hit somewhere around $30, and I'm being conservative. Well beyond 30 would also not surprise me if we reached in the low to mid 30s by the end of the year, if we have this kind of environment and pace continue. 30 and up, 30 to mid 30s by the end of this year would not be a surprise.
Let's peel back the layers of the silver market to understand why we're on the cusp of something monumental. In 2024, the global silver deficit is expected to widen dramatically by a staggering 17%, reaching an eye-watering 215.3 million troy ounces. This isn't just a number, it's a clear signal of a shifting tide. But what's driving this deficit? It's a potent mix of increased demand and a shrinking supply. Demand for silver is projected to grow by 2%, primarily fueled by its critical role in various industries, from high-tech electronics to solar panels, each hungry for more silver than ever before. Meanwhile, the supply side can't keep up, anticipating a decline of 1%. These figures aren't merely statistics. They are the harbingers of a tightening market where demand outpaces supply, setting the stage for a dramatic escalation in silver prices. As we continue, we'll delve deeper into each factor contributing to this unprecedented scenario. Stay with us as we explore the industrial appetite driving this demand and the broader implications it holds for investors and the global economy.
Have some reaction in terms of supply, I think, is probably more than anything. I don't think recycling will be an answer for it either. Is going to be, if anything, on the physical investment side, where you have dishoarding, people selling back into the market. I don't think that's going to be a huge thing either, especially if we're in an inflationary environment, which I think we will continue to be. And so in that kind of environment, at $35, $40, chances are you will have some people selling back into the market and helping to boost physical supply. That may alleviate it a little bit. But then on the other hand, you've got buyers of physical silver who see the inflationary environment and say to themselves, well, I'll take that silver. You're selling it off into the market. I'll happily take it off of your hands, and paying higher than normal premiums even these days for it. So, reaction from supply, all angles of supply, I really see as quite minimal. And so the only answer is higher silver prices, really. And even still, not much supply reaction with higher silver prices. So that's, amongst probably the surest bets in the market right now. There's almost nothing that is more undervalued. You'd be really hard pressed, I think, to find anything across the markets that is more undervalued and better value than silver and silver stocks at this point.
Turning our attention to what's truly driving this surge in silver demand, it becomes clear that modern technology and green energy solutions are at the heart of the story. Silver's role in the industrial sector cannot be overstated. It's a linchpin in the production of various essential and cutting-edge technologies. Last year alone, industrial demand for silver surged by an impressive 11%, a testament to its critical applications. Why this spike? Silver is a key component in electronics, electric vehicles, and most notably solar panels. Each of these sectors is expanding rapidly as global demands for sustainable and advanced technologies increase. As nations and corporations push towards greener solutions, the demand for solar panels has skyrocketed, with silver playing a crucial role due to its unmatched electrical conductivity. Every new solar panel installed represents a significant quantity of silver tucked away, effectively removed from immediate market circulation. Moreover, the electric vehicle industry, which relies on silver for its electrical contacts and batteries, is experiencing a similar boom. This burgeoning demand paints a vivid picture of a market straining under the weight of its own needs, with silver right at the center, shining brighter than ever as an indispensable resource. Stay tuned as we further explore the historical price movements and market dynamics that have led us to this pivotal moment.
I mean, you're right. Gold is setting new all-time highs. I was at a conference a little under a month ago, and it was actually in Zurich. And it was interesting because it had been about a week or a week and a half, gold had really started to push up. And people kept asking me, is this it? And I would say, look, I can never really tell you. No one really knows 100%, but there was one last major currency that needed to set all-time highs in that currency for gold. And that was actually, oddly enough, the Swiss franc. And it did. It had done so a few days earlier. And so I was saying that I do think that this is it. This is the start of a new sustained rally in gold. We have that one last bit of at least that indicator, the last major currency now setting all-time highs. And so we're seeing that, as you say, we're seeing that daily almost in gold. And we've seen, so really the rally in gold, I think, if you look back sort of on a yearly basis, it looks like it really actually started more like in October, but really took off, as you say, about a month and a half ago. And silver has kicked in along with it. Now, silver has been catching up in the last few weeks. Both look like they've taken off around the end of February. And I actually did a comparison chart looking at some ETFs. So to look at the sector, silver juniors, silver stocks, silver and gold stocks and gold juniors, and the silver juniors was outpacing all of them. So it's really interesting to see we're getting a real sort of kick in this rally now, and silver juniors are.
To truly appreciate the potential trajectory of silver prices, we must journey through its historical financial landscape. Silver, often overshadowed by its illustrious cousin gold, has had a tumultuous financial history, one that offers us valuable insights today. From the Nixon shock in 1971, which untethered the US dollar from gold and indirectly impacted silver, to the meteoric rise in the 1970s where silver prices increased a staggering 24 times, history paints a narrative of dramatic highs and lows. After reaching its peak in 1980, silver has generally underperformed compared to gold. But this historical underperformance is exactly what sets the stage for its potential explosive rise today. The month-end price ratio of gold to silver since 1971 reveals a long-term pattern. Silver lags but eventually catches up, often surpassing gold in percentage gains during bull markets. This cyclical behavior suggests that silver, now at a critical juncture and buoyed by significant industrial demand and market deficits, may be poised to break out of its historical shadows and surge to unprecedented levels. Understanding this past is crucial as it informs our expectations and strategies. It's not just about looking back, it's about learning from these patterns to predict future possibilities. Up next, we'll explore how market mechanics, particularly changes in trading practices, have influenced silver prices and what this means for future investment strategies. Stay with us as we decode the intricate dance of market forces and historical trends shaping the destiny of silver.
Disparity, like you say, gold at all-time highs, silver barely at half of its all-time highs. And silver always lags gold. We know that. Gold is moves first. It's the king of precious metals. Always has been and always will be. I don't dispute that. But silver can provide better returns. It has more leverage. And as I say, it runs later, but it ultimately ends up catching up with gold and typically outperforms. We've seen that in nearly all bull markets since the 70s, silver will catch up and outperform gold. Why is it, has it been facing overhead resistance? And I'm going to say that's probably been in the last 3 years or so, 3 to 3.5, 4 years. I had the sense that because we're facing structural deficits in the silver market, so your supply really comes from mining and from recycling. And then you've got what I call secondary supply, which is what typically sits at the futures exchanges, sits in silver ETFs. And the sort of third part of it is physical hoards. People who own silver sit on it. That could be personal investments. It could be strategic ownership. That could be larger investors. So you've got these three aspects. You've got, again, the silver futures exchanges, the ETFs, and then you've got these private hoards of silver. And I kept thinking to myself, well, if there's a structural deficit and the price is not moving, these large consumers, especially on the industrial side, which has now moved to about 60% of the silver market is industrial consumption. These consumers are getting it somewhere. And I started doing some research looking at the inventories the three major exchanges, the COMEX, the LBMA, the Shanghai, and the silver ETFs. And over the last 3 to 4 years, all of them are down. Their inventories are down 30 to 40%. And if you look at what they call registered silver at the futures exchanges, the registered silver is what is actually silver available for delivery. And that silver is down 70%.
As we delve deeper into the factors influencing silver prices, it's crucial to understand the mechanics of the market that have shaped its trading dynamics. A pivotal moment in the history of silver trading occurred with the introduction of the Big Bang financial market legislation in 1986 under the Thatcher government, which dramatically altered the landscape of the London gold and silver markets. Previously, physical gold and silver bars were required for trading backed gold and silver contracts of the London spot or cash markets. However, the creation of the London Bullion Market Association, LBMA, and the shift to trading unallocated spot contracts, essentially promissory notes for delivery, revolutionized these markets. This meant that the physical bars could be outnumbered by paper claims, creating a scenario where actual silver could be vastly outweighed by claims on paper. This system allowed for the proliferation of paper claims on silver, providing a mechanism that could suppress physical silver prices despite underlying market demands. It effectively decoupled the paper price from the physical reality, allowing for more volatility and manipulation in silver prices. These market distortions are essential to understand because they highlight a vulnerability in silver pricing that can lead to significant price movements when physical shortages become acute. Next, we'll compare silver's performance against other assets, illustrating why it may now be one of the most undervalued assets in the market. Understanding these mechanics is not just academic. It's a critical component of forecasting how silver might behave as these historical market manipulations come to a head with current economic pressures.
It's even more complicated, and it makes silver what we call in economics inelastic. So demand can go up, and the price may not react even for at least a while. You can get the inverse. Price can go up, will not affect demand and lessen demand. Price can go up and supply will not necessarily react for multiple reasons. So that's a great, as you pointed out, that's a great factor in the silver supply, very particular to the silver mining industry. About 70%, as you say, comes from mining other metals. So it's a byproduct. In 70% of its mined supply is as a byproduct of mining things like gold, copper, lead, and zinc. So another way to look at it is 70% of the mine supply depends on the production of these other metals. So if you think about the mindset of miners of these other metals, they're going to look at their silver production as a byproduct and say, I don't really care what the silver price is. It's not material to my revenues. It's not material to my income. Silver price could be $40 or $50. They'll be happy to accept it. but they're not going to go out of their way to try and produce more silver to try and meet this higher demand. They'll just sell it into the market at the higher price, and as I say, happily accept that price and higher margins because of it. So you've got this weird setup where higher demand can beget higher prices, not have a reaction from the supply side, and therefore beget even higher prices. So you've kind of got this upward spiral. It's going to be very interesting to see what happens. And when silver and gold are very particular for that. People tend to kind of chase the prices of these metals when they go higher. They get more interested when they're setting new all-time highs, and that helps to push sometimes the prices even higher. So I think we're in a spot now, a sweet spot, where it's looking very, very interesting and very bullish for the.
In this segment, we delved into a comparative analysis that underscores why silver might just be the sleeping giant of investment opportunities. Let's compare its performance to other major assets like the S&P 500 and gold, which provides a broader perspective on silver's potential value in today's economic climate. Since the deregulation changes in 1987, the S&P 500 has seen a meteoric rise, increasing by approximately 20 times, buoyed by expansive monetary policies and a burgeoning tech sector. In contrast, gold has appreciated 3.7 times, while silver has risen only 2.9 times in the same period. This discrepancy highlights a stark underperformance of silver compared to both the broader market and even gold, suggesting that silver may be significantly undervalued. However, this underperformance is not just a sign of weakness, but rather an indicator of pent-up potential. Historically, silver tends to rally sharply after periods of lagging behind gold, as seen in the late 1970s and early 1980s. Given the current economic uncertainties, central bank policies, and increasing industrial demand, conditions are ripe for silver to break out of its undervaluation cycle. Understanding these dynamics is crucial for investors seeking opportunities where the potential for growth is significant due to historical undervaluation. Next, we will engage our viewers by asking for their perspectives on what could be the biggest drivers for silver's price in the coming years, fostering a dialogue that could provide further insights into market sentiments. Stay tuned as we continue to unravel the complex web of factors driving the silver market, paving the way for informed investment decisions.
Yes, I did say that, and that was because of some insight I've gotten from the industry. And to your point, and it's great to get your direct experience as well with that. That was something that I had recently read, that bullion dealers are seeing almost on a 2-for-1 basis. Clients are selling back to them versus clients buying. So 2 ounces being sold back for every ounce being bought. That says a few things to me. So it says that you've got some weak hands that probably bought high, see prices where they've either come back close, depending on which metal and when they bought, back close to what they bought at, and they just are saying, I'm out. I just want to break even. Or for other reasons, people are perhaps squeezed monetarily. Inflation's not obviously an easy environment for many. Perhaps they need liquidity, so they're selling selling back to dealers. They're selling at what they feel are relatively attractive prices. But as you say, that's nowhere near the kind of environment where you see things really building up towards any kind of a peak. It's much more reminiscent of the beginnings of a bull market. So there's a lack of conviction. There's very weak sentiment. There's almost no reporting of what's going on in silver and in gold in any of the mainstream media. And so really, this is an opportunity. I mean, if people think they have missed the boat, I can say very confidently that the boat is still sitting at the dock. You have a little bit of time to get on board. At one point, yes, it will leave, but you still have time. So I would encourage people, takes a bit of time. You don't have to jump in right away with both feet. Start looking at this seriously, understand the market, do some research, subscribe to some newsletters if you think that you want some guidance, especially when it comes to stocks. And if you're going to deal with a bullion dealer, look for reputation, look for experience, and yeah, I mean, the opportunity absolutely is there. You've got.
As we explore the fascinating dynamics of the silver market, I'd love to hear your thoughts. What do you think will be the biggest driver for silver's price in the coming years? Is it the insatiable industrial demand, the intricate market mechanics, or perhaps the historical cycles of underperformance and surge? Drop your insights, theories, and predictions in the comments below. Let's start a conversation and see what the collective wisdom of our community can uncover. Engaging with these ideas isn't just about speculation, it's about preparing for potential future scenarios. Whether you're an investor, a market enthusiast, or just curious about precious metals, your perspectives enrich our discussion and help us all gain a deeper understanding of the forces at play. Stay tuned as we move into our next segment, where we analyze the strategic implications of current buying patterns and what they signify for the future of silver. Your input is invaluable as we connect the dots and build a comprehensive picture of where the market might be headed. So don't be shy. Join the discussion, and let's delve deeper together into the silver saga.
And stocks at near all-time highs, massively overvalued by so many metrics. Here's a little interesting insight. I was talking to someone from one of the larger silver miners, in fact, just yesterday, and they see huge volumes in their shares, trading day in, day out the last few weeks. And so they're talking to the traders at the trading desks from the investment banks, and they're asking them, okay, so what's going on? They want to get this direct insight, and they're telling them they're getting tickets for 10 million shares at a time in some cases. Huge buying going on right now. At least it's the larger names, it's the more liquid names, and they're getting this from the generalist investors. So you've got some really, really smart investors who are perhaps not necessarily, precious metals bulls, but do see the writing on the wall with general stocks at or near all-time highs, especially when you're talking about things like tech, and see the markets, the general markets, as highly valued, highly overvalued. And the very, very smart money is starting to rotate into the deep value. And they're doing it in liquid names, and they're doing it at the lower risk end of the curve, which is certainly the miners, the larger miners. And there aren't that many. So that's what I think explains the big volumes, because the money has to go into very few names. And that's, I think, what's going on. That's why you're seeing such big volumes in you're seeing some of these larger caps just jump 4%, 5%, 8%, sometimes in a single day. It's just tremendous action to watch. And so that's the beginning of the move. And that's why I say that people still have time. I wouldn't wait. I wouldn't waste any time, but they do have time to get started, do research, get involved. But as I say, the smart money is clearly starting to move in. That to me is the indication, one big indication of the start.
As we edge closer to our conclusion, it's crucial to understand the strategic maneuvers shaping the silver market today. The buying patterns we're observing, especially in the realms of ETFs and futures, provide a window into the strategies of major players and their potential impact on silver prices. Investors and large entities are increasingly turning to silver ETFs and futures contracts as a way to hedge against economic uncertainties and to capitalize on the anticipated price movements. This shift is not just a mere trend, but a strategic play that reflects deeper market insights. The substantial increase in ETF holdings and the active trading of futures contracts suggest a growing belief that silver is undervalued and poised for significant appreciation. Moreover, this strategic accumulation of silver assets highlights a savvy anticipation of tighter market conditions. With inventories at major exchanges dwindling and industrial demand outpacing supply, these large-scale purchases are strategic positions taken to capitalize on a potential squeeze in the silver market. This scenario could dramatically shift the supply-demand balance, further driving up prices. As we prepare to conclude our exploration in the next segment, remember these strategic movements are not just about market speculation. They are calculated decisions based on a comprehensive analysis of market conditions, historical cycles, and future forecasts. Keep this in mind as we move to our apex, where we'll tie all these threads together to form a coherent picture of what the future holds for silver. Stay with us as we're about to reveal how all these elements converge to potentially trigger a rally like no other in the history of silver.
My conclusion is that this is where the large consumers have been getting their silver, and in that kind of environment, not pushing silver prices higher because they've been sort of soaking up this secondary supply that's just sitting there. So I think that they're buying long futures contracts waiting for them to mature, taking delivery, buying silver ETFs. They're allowed, if you own certain ETFs and you own enough of those ETFs, you can actually go to the manager and say, I want to turn my units into physical silver, and here's the address. I want delivery. So I believe that's what they've been doing. They've been fulfilling their requirements through these means, and it's helped to keep a cap on the price. So how long can this last? So that's sort of the next phase of it, or the next part of it. I think just, given how much these inventories have come down and the rate of growth in demand, both from investment and from industry, I think we're anywhere from 12 to 24 months ish, where, if this kind of soaking up and draining of these inventories continues, that we're going to reach a point where the inventories are essentially empty, other than perhaps the personal physical hoards. Interestingly enough, there was a report by TD Bank just recently that said nearly identically the same thing. They see anywhere from 12 to 24 months where this can continue, and then the game is over, and we will have essentially run out of this kind of secondary silver. And it's interesting to point out too that recycling has not moved. Mining supply has not moved. It peaked in 2016 at 900 million ounces per year. We're down now to about 800 million ounces for the last few years. There was an interesting bit of research by Bank of America that looked at, they surveyed the 13 largest primary silver mining companies, and they all expected that we are going to see similar mine output over the next several years. So mining output is not responding to the demand. So, as I say, this secondary silver.
In conclusion, as we've unraveled the tapestry of factors influencing the silver market, we'd arrive at a compelling point. Silver appears on the brink of an unprecedented rally. The convergence of a global deficit, surging industrial demand, strategic market maneuvers, and historical economic cycles heralds a future where silver could soar to new all-time highs. This isn't just speculative. It's a forecast built on a robust foundation of data and trends that signal a seismic shift in the valuation of this precious metal. The current market conditions, characterized by tight supplies and robust demand, particularly from tech and green energy sectors, are the kindling for this fiery potential rally. The strategic acquisitions and holdings in silver futures and ETFs are not merely defensive moves, but proactive strategies to leverage the anticipated scarcity and price spikes. As investors and market watchers, the message is clear. Stay informed, stay engaged, and be ready. The indicators we discussed today suggest that now is a time of great opportunity for those who understand the undercurrents driving the silver market. Remember, the key to capitalizing on such trends is not just in recognizing them, but in preparing for them. Make sure to subscribe and stay tuned for more insights that help you stay ahead in the game. Finally, a reminder, while the prospects are bright, every investment carries risks. This analysis is not financial advice, but an informed look into the dynamics that could shape the future of silver prices. Always ensure your investment decisions are well considered and align with your financial goals and risk tolerance. Thank you for joining me in this exploration of the silver market's potential. Let's watch closely as the future unfolds, potentially more lustrous than ever for silver investors.
Example, in fact, that I'll address that specifically in a moment, but about a month and a half ago, I was at a mining conference, and a large primary silver producer that is not in North America sells half of their production to China and the other half to the West. Well, the CEO of the company told me that they see it daily. They said that the market is very tight. The Chinese buyers are coming to them and saying, "We are prepared to pay you a couple of weeks in advance. We really need this supply. We will in fact pay you $3 over spot in order to get that supply." And I mean, the market is tight in the West as well, but I think that because solar has become such a driving force in the silver market, with now representing about 20% of all silver consumption, just going to the one application of solar panels, and China controlling 80% of that production of solar panels. I think that they really absolutely need it. They're not getting it as well as they may try in all the possible sources, offtake agreements, whatever they may have, even going to these futures markets, going to the silver ETFs, they have domestic production. It's just not enough for them. So the market is very tight. This is anecdotal, but I have reason to, believe it and take it very seriously. And I just think that the mine supply is not going to react very much at all over the next couple of years. I just don't see it. We have not found much, if any, new silver mines. There's not much being spent on exploration. General mining capex is at decades lows. We've been through a bear market in commodities where the mining companies have pulled in their reins, have cut spending dramatically. The capex has not been there to support higher demand. So what happens is, and we saw it in the last resource bull market, is that demand builds up, stays high, stays sustained high, and it stays there for a while as I guess these conservative or newly conservative, perhaps, mining CEOs see this and say, "Okay, we need to start reacting to this. We need to start spending on exploration. We need to start spending on capex to build our mines out." And then eventually it catches up, but that could take 5 to 10 years. Finding a mine these days, just from discovery to growing the resource to getting it permitted, financed, building it, be anywhere from 10 to 15 years. And different jurisdictions, start to become more difficult or less friendly to some of these projects. So I think that it could take really some time to play out for supply to catch up. And we've seen the primary silver miners do not see it happening.